Hey everyone, welcome back to Corporate Decoder, the place where we decode corporate filings so you don't have to. Today we're diving into a recent filing from Dermata Therapeutics. Get ready because it looks like they're trying to clear up some old business by issuing a whole bunch of new warrants. It's like when you try to organize your closet by shoving everything into a drawer, but does it really solve the problem? Let's find out. Dermata Therapeutics made a deal on March 27, 2025. They made an agreement with someone who already owned warrants, which are like coupons to buy their stock. These existing warrants allowed the holder to buy over 4.8 million shares of Dermata's common stock. The original warrants were issued at two different times in 2024, once in May and again in September, with different prices for buying the stock. The original warrants were issued at two different times in 2024, once in May and again in September, with different prices for buying the stock. Think of it like having two sets of coupons for the same item, but one set has a slightly higher price. Dermata basically offered the warrant holder a deal. Exercise your old warrants now at a lower price of about 1.28 cents per share. In exchange, Dermata would give them new warrants in a private placement outside of the public market. These new warrants are split into two series. The first new series allows them to potentially buy almost 5 million shares, and the second new series allows them to potentially buy almost 5 million shares, and the second new series allows them to potentially buy almost 5 million shares, and the second new series allows them to buy nearly 4.7 million shares. This deal closed quickly, just a day later, on March 28, 2025. Dermata got about $620 above the warrant holder exercising their old warrants. They plan to use this money for the usual company stuff: research, clinical trials, developing new technologies, and maybe even buying other companies that fit with their goals. It's like getting a small loan and using it to fund different projects around the house. Dermata hired H.C. Wainwright & Co., or HCW, as their financial advisor, sort of like a consultant. They are paying HCW a fee equal to 7% of the money Dermata received from the warrant exercise. Dermata is also giving HCW warrants to buy over 38,000 shares of stock, which is 7% of the number of the original warrants. These HCW warrants are similar to the new warrants being issued, but with a slightly higher price of $1.60 per share, around 25% higher than the lowered warrant price. Dermata needs to file paperwork with the SEC so that the warrant holder can eventually resell the shares they might buy with these new warrants. They plan to get this done as soon as possible and want the SEC to approve it within 90 days. Dermata is also promising not to issue more stock or similar securities for 60 days after this deal, with a few exceptions, and not to do any variable rate transactions for a year, again with some exceptions. Basically, they're trying to keep the stock price stable for a while. Let's look at some details of these new warrants. The exercise price is about $1.28 per share, same as the reduced price for the old warrants. However, the new Series A warrants can be used for 5 years after stockholder approval. Series B warrants have a shorter lifespan, just 18 months after stockholder approval. The price and the number of shares you can buy with the warrant can change if Dermata has stock splits, dividends, or other similar events. Here is a kicker. To use the new warrants, Dermata needs to get approval from its stockholders because of NASDAQ rules. They are promising to get this approval at their next annual meeting. Once stockholders give the thumbs up, the warrant holder can use the new warrants to buy shares, but they can't own more than 4.99% or 9.99% of Dermata's stock after using the warrants, unless they give the company notice and wait. If the paperwork to resell the shares isn't approved, the warrant holder can choose to do a cashless exercise. Instead of paying cash, they would get a smaller number of shares based on a formula. It's like trading in your coupons for store credit instead of the actual product. Until they actually use the warrants to buy stock, the warrant holders don't have the same rights as regular stockholders, like voting rights. If Dermata is bought out or merges with another company, the warrant holders get the same deal as everyone else, either the equivalent shares in the new company or cash. The terms of the warrants can be changed if both Dermata and the warrant holder agree in writing down. Let's zoom out and look at the bigger picture. Dermata seems to be using these warrants to get a quick cash injection. It's a common move for companies that need funds for research or development. On the one hand, it's good that they're securing funding. On the other hand, issuing more warrants can dilute the value of existing shares, meaning each share is worth a little less. Think of it like cutting a pizza into more slices. Everyone gets a smaller piece. One notable risk is that the stockholders might not approve the new warrants. If that happens, the deal falls apart and Dermata would need to find another way to get funding. Also, there's no guarantee that the SEC will approve the resale registration quickly. Overall, this looks like a calculated gamble by Dermata. They're betting that the short-term pain of dilution is worth the long-term gain of having more cash on hand. Whether it pays off remains to be seen. Thanks for watching. If you found this breakdown helpful, please like, comment, and subscribe for more corporate decoding. Let me know in the comments which filing I should tackle next.